All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA-registered, SIPC-insured US-based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted and get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description. Hey, everybody. Welcome back to Investing Unscripted, where we ask the hard questions about investing. I'm Jason Hall, joined by my good friend, Jeff Santoro, voice of the people. Hey, Jeff.
Hey, how are you?
I'm good. I'm surprisingly good. The past 2 weeks for investors, it's been a lot.
I was going to say, you sound a little tired, energy levels a little lower. I think the market is just wearing you out.
Yeah, it's grinding me down. No, the past 2 weeks, dude, tariffs, but no tariffs, but sort of yes tariffs. Last week, AI, China killed AI.
Yeah.
But it didn't really. It might have done something really good for AI, but we don't know.
Yep.
It's a lot.
It's a lot. And it's a lot of, I guess, you know what surprises me? And we'll talk about this, I guess, throughout the show. I'm just diving right in here, Jason. I'm surprised the market's not just down, because what all of this says to me is uncertainty.
Yeah.
And that's what everyone always says the market doesn't like, but it seems like it's handling uncertainty pretty well right now.
Well, Jeff, it brings us to the title of this week's episode, Stuff Happens.
Stuff happens. Did you like that professional transition?
It was really good until you asked me if I liked the transition that we just did on the recording.
Here at Investing Unscripted, we bring people behind the mic.
That's right.
We let them in. We break the fourth wall. Is there a fourth wall in audio?
I think there's only like 2 walls in audio.
We break whatever wall is up.
We break things.
Let's move on.
It's almost like we're unscripted.
Almost. We're taking our name too literally.
All right. So before we get into it, the name of the episode and the theme is just that reality, is that to some degree, we're always operating in uncertainty, and stuff is going to happen, and it does happen. So we're going to talk through the past few, we can go back as long as either one of us can remember and talk about specific incidences, but we also want to talk a little bit about how we get through it, right?
Yeah.
Well, what do we do? How do we come through it? And just surviving through it, much less thriving and succeeding, which we'll also talk about. But Jeff, before we do that, any housekeeping?
There is housekeeping. I'm happy to report that we've seen an uptick in questions for our mailbags, but even though we've seen an uptick in questions, Jason, we have not seen an uptick in 5-star ratings and reviews on the podcast apps. So if you're listening and you're enjoying the show, there are a few things you can do to help support us and to help more people find it. One is to just send the show to somebody, send them a link. And the other is to give a 5-star review on either Apple Podcasts or Spotify. And on Apple Podcasts, give a review. Type a couple words, say something nice about the show, what you like. That's a great way for people to find the show.
Yeah. And if you have a following on social media, or you know somebody that has a following on social media, we're always happy to let people shill on our behalf too. Share it with people. Definitely. Not just send it to a friend, but share it on your social media too. We really appreciate that very, very much. All right. Without further ado, I never say that. I'm never going to say that again. Hey, let's get to the podcast. What do you say, Jeff?
Without further ado, let's talk about... No, so here's where I think we should start, Jason. Let's just try to tick off. We wrote a couple down, so this is a little bit scripted. All of the market things that have happened that we can think of just in the past couple of years. All right, so we talked about the tariffs. That's like the latest thing right now. And by the time this goes out, we're recording this on the 4th after the market close. So by the time this goes out on next Wednesday or the day you're hearing this, who knows what'll happen with tariffs?
Well, that's the thing, right? So even just let's stay on this one for a second. So over the weekend, President Trump said, okay, I'm hitting Canada and Mexico both with 25% tariffs. And China, look out, here comes 10% tariffs. Before they could even really come into effect, Canada and Mexico both had come to a preliminary agreement, primarily at the borders in terms of border security, to do more to limit the import of illegal drugs, primarily fentanyl, crossing into the US. And there's a pause, a 30-day pause before any tariffs are put into place. China and President Trump and the Chinese president were going to talk, but apparently now they're not, because China has already retaliated with some tariffs. So it's on again, off again, on again, sorta. Story's definitely not over, right?
No. Because even like you said, the ones on Canada and Mexico were just delayed a month. China's a moving target. Like before we finish recording this, that could all change with some agreement, right? And then who knows how long that agreement lasts. So
right.
This is the hottest story right now as we're recording, and it could or could not be by the time this gets published, and it'll change probably multiple times between now and then. So that's the most recent. But then just last week, which now feels like a month ago, was the DeepSeek news, where it was either really good or really bad for AI, or both, depending on who you are, what you're invested in, what your view is. So we'll see how that's not over. That's still shaking out.
Right. And that one, between the two, the interesting thing is that DeepSeek certainly has had the biggest impacts on markets because of the impact on the Magnificent Seven and other companies as well, ASML, really any company that's exposed to semiconductors on this side, the part of the value chain that deals with AI, which is the majority of it. There have largely been negative short-term implications and some maybe longer-term positives, but it's a net down for investors. And the thing that could send the entire world into recession, investors just haven't really blinked. Stocks market was down a little bit Monday. It's recovered Monday afternoon, and here on Tuesday it closed up. So yeah, 2 weeks in a row of big stuff. And the one that probably has the most downside implications, Jeff, the market's like, all right.
Yeah. It says to me that the market doesn't really believe that the tariffs will happen, or if they do, they'll be short term. That's the only thing I can, that's the only way I can sort of justify or explain the lack of reaction, is that the market's just saying, yeah, maybe, but probably not.
Oh, that's exactly right.
And it's interesting to watch. Like, so with the DeepSeek news, like the market that day actually did fine, but anything that touched AI got hammered. And then with the tariff news, it was one of those days where the markets opened down pretty not significantly, down 1.5, almost 2%, whatever it was, but ended barely down, under 1%. And over the course of the day, it just sort of ticked back up as these deals were agreed to stop the tariffs. So anyway, that's the latest. I guess, Jason, the last probably big market moving event prior to this past week was the election, right? We saw that big post-election bump. Any stock that was perceived to benefit from any policies that had been talked about on the campaign trail. And I think just overall, probably some the tide lifting all boats, just in the sense that the consensus
lower
is
taxes, less regulation,
less regulation, a more business-friendly administration is the way I've heard it put.
At the same time, Jeff, it's interesting because tying the threads together here a little bit with tariffs, one of the things that was an outcome of the election is we did see back then retailers, particularly like electronics retail. Well, all retailers now rely on goods that are manufactured in China or contain components that are manufactured in China. A lot of real estate related investments because of concerns about pressures on interest rates, particularly industrial real estate companies that own like logistics and warehousing and, light manufacturing companies like Rexford Industrial, for example. So back in November, the companies where investors saw downside risk and threat from things like tariffs and an aggressive potential trade war with China, those stocks have already had a lot of that risk priced in for 3 months at this point.
Right. Yeah. And maybe that's just a part of, or even a better explanation to why the market's been less reactive now. Maybe to some degree that got priced in slowly over the past couple of months. So I guess, unless I'm missing a big event, Jason, I think the going backwards in time from the election, probably the last big market news was that CrowdStrike outage in July. And again, that wasn't a market-wide reaction. That was a reaction to one or, some specific stocks, right? CrowdStrike, obviously. And then I think the airlines, got hit because of how they reacted to the CrowdStrike outage. That was one of those less macro impact events and more impacted the people who own that stock.
Hey, everybody, we'll be right back. But first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellow Brick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com.
The last one I remember before that was the summer before, when we had those 2 days in August, I think it was, where the yen carry trade.
Three words that anybody else that didn't like live through that as an investor would have thought was like some obscure 80s band name. Right?
Yeah. And it was so quick, and it was like a violently down 2 days, and then that was it. It was over. It was very strange.
I mean, most of the money that was affected wasn't directly in the price of the stocks that day. People that had to realize some losses that were doing the selling for other reasons were affected. And then before that, you look at the impact of interest rates, right? Skyrocketing. That was one of the catalysts that led to 2022, right? Being such a brutal down year. We were down from the high 20% at the bottom, and the market stayed down more than 10% even after it started to recover in October.
And the interest rate thing, it's funny, as we approached, the Fed meets quarterly to decide on interest rates. And as we approached each of those meetings in 2023, when we got to the point where people were like actually predicting there might be a cut, the market was very volatile. Like once we found out, like when that first cut happened, you saw a reaction, and then there was a debate. Would it be a 25 basis point cut? Would it be a 50 basis point cut? Would it be more? Would it be no cut? And now there's not that anticipation of these events, because I think there's more consensus that the rates cuts are going to slow down. And now I don't think anyone really knows what to expect. There's so many other variables here. Like the interest rate thing has kind of fallen off the radar, at least as of right now. I don't think that's what people are really trying to think about. But that's one of those that's has been in the background continuously for the last couple of years, right? And that's going to continue. It'll happen again as we approach the next Fed meeting.
So I think the way the market's thinking about it now that's different is that there's not clear consensus on rates coming down as there were a year ago. The expectation was that we would have seen multiple cuts in 2025. There's far less consensus of that now. There's some expectations that we might actually see rates move up depending on a couple of factors, but there's a lot of wild guessing going on. Oh, by the way, Jeff, the FOMC meets 8 times a year.
Yeah, but I thought they only made announcements about rate cuts quarterly.
They don't change rates every meeting, but they meet 8 times a year.
Okay.
So
I was referring to the meetings at which they announce a cut, if there's going to be.
Well, I mean, they reserve the right to make decisions about that pretty
True.
much whenever, but we don't typically see it that often.
Right.
So
But
yeah,
we can go back further, right? There was the banking crisis a couple springs ago where Silicon Valley Bank fell, and then there was obviously the pandemic, and then you can go back through time. There's always these shocks. But I think the way that I'm bucketing these in my mind, because they're all kind of different, right? We've talked through shocks to the market that are completely out of the blue. Like I would put the CrowdStrike outage in that bucket, right? Yes, there's always a threat of a cybersecurity related incident, but I don't think anyone had that particular type of one on their bingo card. Same thing with the yen carry trade. Like, yes, maybe someone was predicting, this could go wrong. And maybe even the same thing with the banking crisis, right? Like there was probably someone saying, hey, some of these banks but they were definitely not broad consensus in the market. And that's why you saw the reactions. But then there's the ones that are still impactful, but kind of expected, right? Like we knew tariffs could be a thing for probably over a year now. It's been talked about, right?
Yep.
We knew that the election was coming. We knew that interest rates were going to change in some direction at some point, right? So there's these like semi-known events. But so that's kind of how I'm bucketing them in my brain, right? There's like the true black swan, like no one saw that coming. And then there's we know these are coming. We know these are things that are going to move the market, but no one really knows when or how or by how much and how long it'll last and all that kind of thing.
Yeah. And we haven't even talked about the war in Ukraine and, the dislocation of Russia's relations with most of the West, and how that's pushing Russia and China and North Korea and parts of the Middle East kind of closer together into a block, and the implications for that in global trade and that sort of thing. But the point is, like to your point, is there's kind of always this stuff happening, right? There's always going to be something that's going on. And the reason that I wanted to make this episode, Jeff, is not to try to go back and autopsy each of these things or try to necessarily look for lessons from each of those to try to learn, but really to talk about the fact that we always operate as individual investors in the environment where there's going to be a certain amount of uncertainty that we're going to factor into our decisions that we're making, whether we should or not.
And I have a not fully formed way of thinking of this that I'm just going to say, and then you can tell me what you think about it. I think back to,
It's terrible.
thank you. I would pause just so you could do that. I think back through my investing life and all the events that I've lived through as an investor, even when I wasn't paying close attention to my investments, right? So, I opened my retirement account probably in 2002 or 2003. Like, I don't know exactly when. So I was right on the heels of, the .com bust and 9/11.
Was absolutely one of those rare, perfect times to be doing it.
Right. With my $100 a month
Yeah,
that
you
I
totally
was
go wrong.
putting in.
Yeah.
But then, I invested through the great financial crisis. I invested through, every other thing that happened. All these things that we talked about just over the past couple of years, like there were similar type events happening to individual companies, to the overall environment all throughout the time that I was investing that I was completely unaware of. And I do remember times when I was aware that the market was not doing well, right? Like I was aware enough to know like what the great financial crisis meant for the stock market and for the economy. But because I was just automatically investing in my retirement account, I never even considered doing anything about it because A, it's a lot of work and it's a pain. And all I really could have done was just stop contributing. And I guess
right.
I guess I knew enough that like I had a lot of time and this will probably kind of figure itself out. Like I guess I knew enough about how things work to at least have that kind of vibe about it. Cause I know I was never like panicked, but I truly don't know what my mindset would have been during all those different things if I was actively picking and buying stocks, where it's so much easier to just open your brokerage account. I guess back then I would have paid a fee, and just go to cash or sell a bunch of stuff or make a lot of changes and tinker and try to be smarter than the market and all that stuff. So I totally understand why that's what people do and want to do, right? It's that desire to do something, to have control. And I feel fortunate that I've learned that doing nothing is fine if you just wait long enough, because that's sort of what I did by default through my 20s and 30s. Not everyone has that experience. Not everyone's in that boat. And right now, just over the past year, it just feels like there's a lot. It's not like one big thing that's taking a while. It's like 1,000 little things that all seem pretty consequential. So it's worth talking through it.
It is. And just to kind of respond a little bit to what you were talking about there, regular individual investors who are just people buying ETFs and index funds in their retirement accounts, at least have enough knowledge and get enough direction to position size appropriately based to the right assets based on how long before they get how long to get to the financial goals that they're saving for, kids' education, retirement, all the stuff, right? All the different things that you're trying to do, honestly, are in a better position than a lot of people that are trying to buy individual stocks.
Yeah.
Because of exactly what you said. The momentum is there. The engine is already turned on. The biggest risk is needing to turn stocks into money in a time when they're going to be worth less money. And if you have the ability, the capacity, those are two different things. Your capacity is that you don't need to turn them into money during that period. Your ability is the mental makeup to leave it the fuck alone, right? Those are two different things. By just doing it automatically and looking at your statement that comes in the email once a quarter or once a year, if ever, immediately removes the biggest risk to wealth destruction that most people have. And that's exactly what you're talking about. The capacity to get in the middle of it and to do something. Because the most important to do something is just to buy and then get out of the way. Right. And then you hit your financial goals, and then you can start revisiting your asset allocation and reducing. When volatility becomes risk, then you reduce the, allocation to things that are risky when that risk is actually risk. That's the most times I've ever said risk in one sentence. Pretty pleased with myself there.
I mean, but that, yeah, I mean, like you're kind of getting at it, but like the big caveat to all of this is like, unless you're about to retire,
Yeah.
that. But honestly, if
people don't wait till then, they try to. We have so much recency bias right now, Jeff, to the experiences that we've lived through as investors in the past just 6 months, much less the past 5 or 10 years. The further we move from those things, the less we don't even remember. We don't even think about them. I guarantee there were 3 or 4 notable things that have happened over the past 5 years that moved the market in big ways and were the lead subjects on CNBC shows for hours and hours
And
that
we
we
just
don't
didn't
even
think about it,
remember,
yeah.
right? They're immaterial in terms of the long term and the impact that they have on our ability to create or lose wealth. Where they impact us is they give us opportunity to lose wealth.
Well, yeah, I mean, well, that's what I was getting at. Everything we're saying about being patient and waiting it out and buying when the market's down and doing nothing, like, is good advice to people who have the time to wait for things to recover. What I was going to say is, like, I understand why the panic level would be higher for someone who needs that money sooner.
Yeah.
But that's why most financial professionals, which we are not, but we've heard them say it, so we can just at least repeat it, tell you not to have too much risk in your portfolio when you're close to needing that money for exactly everything we're talking about. Right. You want to live in a world where a big market shock, isn't ideal, but doesn't prevent you from being able to retire when you want, or prevent you, or being able to pay your bills, or forcing you to sell a stock you've held for 30 years while it's down 40% because you need the money, like all those kind of things.
Yeah, no, that's exactly right. So if you owned Apple in 2009, it would be pretty easy to, let's say that you had $10,000 of Apple in 2007 and you had $4,500 of Apple in March of 2009. You hadn't bought or sold anymore. Didn't pay a dividend back then, so you didn't have drips or any of that kind of stuff. It could be pretty easy to say, I've lost $5,000, right? I mean, you could say that. But some people think this is just semantics, but I think the mental shift away from thinking about stocks as dollars can be so powerful, because we have to value it by something, and it makes sense to value it by the thing we're going to turn it into when we need money, and that's money. But if you still own the same amount of Apple and that same wonderful business, you still have the same economic productivity that you had. The key is changing that framework in your brain, and again, having the capacity to hold and not have to turn the business interest back into money. It's so important. So, like, we were talking a little bit about how, largely these things are noise, and they're not, they're immaterial. March 2020, March 2009, the world was on fire. Both of those cases. Back in March of 2009, it's easy to look on the tracker, the chart. the S&P was down 55%, the Dow was down almost 60%, and say, well, stocks started going back up. Oh, everything was fine, right? Right? No. You remember the pigs? Portugal, Italy, Ireland, Greece, Spain. There was very real possibility they were not going to stay in the Eurozone, right? Buried in debt. Economies were wrecks. 25%. It was bad. Like, people in the States think it was bad here, and it was bad here. It was twice as bad in a lot of those places. There was real risk that we were going to be back in recession in 2010, and it would take many more years to recover. But things started to stabilize, and the market, by fits and starts, did climb from that bottom. But the point is that even in those periods, there is always as many reasons to be convinced that it's only going to get worse and sell in that moment of capitulation. It can be really heavy, right? It really, really can.
Hey, everybody, we'll be right back, but first, a word from our sponsors.
All right, if you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA-registered SIPC-insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted. Get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description.
Investing Unscripted is brought to you by the Chit Chat Stocks podcast. That's right, another investing podcast you need to add to your listening rotation. My name is Brett, one of the hosts, and I produce 2 episodes weekly along with my co-host, Ryan Henderson. On the Chit Chat Stocks podcast, we talk stocks, a lot of stocks, from the hottest names to undiscovered gems, interviewing sector experts, studying super investors and why they are successful, and we have a fun time while doing it. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and never miss an episode.
Yeah, and it's, when you were talking about Apple a few minutes ago, you said like having the capacity to just hold through those times and kind of see the forest for the trees. But a lot of that has to just do with, just an understanding of market history and how this kind of works. And it's only nerds like us that spend a lot of time talking and thinking about this, and the people who listen to podcasts like this, who are not nerds, who are very smart, handsome,
they're savvy,
beautiful people, that you are educated in how this all works. And then that gives you the confidence, it gives you the knowledge to say, this too shall pass. So I think it's both of those things. And I just don't think, and this goes back to what we talk about a lot, which is, people invest for the same reason. They want to make more money, but people invest in all different types of ways to get that money. And, this is why we're such heavy advocates of thoughtful, long-term, know your goals, work towards them, versus like, how do I get rich in a month? How do I make $1 million in 2 years? How do I have a stock that goes up 300% by the time my kid goes to college next year, right? Like, that thinking is the thinking that's also going to get you shaken out of your stocks when the market really falls. Because the other thing that's scary, I think, for a lot of people, and this is something that I'm starting to get over, like when you get to a point, when you've been investing for a long time, if you've just been diligent with it, you'll have a portfolio that's larger than the amount of money you have in like your bank account. And you start seeing dollars in the investment account that would freak you out if they were in your checking account and they were gone.
Right.
Like if you own a lot of a
stock, if your
stock,
checking account moved up and down that much and you never actually were adding or taking money away, you would change banks.
Right. Well, no, but just think about it, right? Let's say you've bought $1,000 a year, right? Which is not a huge amount of money for most people, $1,000 a year. You put into Apple. We'll just keep using Apple as the example, but you did that for 15 years. Now you have $15,000 worth of Apple, just cost basis wise, right? And now it drops $6,000 because there's a big market thing, right? And you're a younger investor, you don't have that much in, and you say, wow, I just lost $6,000. If you just spent $6,000, that would probably really impact you, right?
Yeah.
But you have to look at it as, what is that as a percentage of this huge pile of wealth you're trying to build for retirement? Because the other thing, like I didn't know when I was younger, like the amount of money you need in a retirement account, it's a lot of money.
A lot of money.
Like if you're going to live on it for God willing, 30 or 40 years after you retire, it's got to be millions of dollars, you know?
Right.
And like when you're 25, the idea that like you might have a couple $1,000,000 in 40 years is crazy for a lot, for it was for me anyway, you know? So there's a whole bunch of like psychology that goes into this. And I just think understanding like how this all kind of goes and the ebbs and flows of the market and, you know, can really help get over a lot of those things. All right.
Yeah. That's really good.
Want to wrap it up?
Yeah. Let's go have coffee.
So, all right, here's the question I want to pitch to you, because this is my struggle with the how to handle these things when they happen, besides all the philosophical stuff we're throwing at everyone right now, which is this. And I've thought about this over the last couple weeks with all the crazy news we've had. The hard part with reacting and trying to do something with these events is there are a lot of knock-on second and third order effects to these things that happen in the world that I think most people either aren't knowledgeable enough about to really understand, but even the people who are knowledgeable get it
So you
wrong.
mean all of these tariff experts on Twitter? Maybe they're
No, but even the real
the
experts.
people that were AI experts.
Yeah.
The week before.
Right. Well,
Okay,
there's two.
okay.
No, I'm talking. There's two categories. There's the people who like pretend like they know and they really don't. But then even the people who do know, there's conflicting opinions on how this could happen, right? Because you don't know what the reaction to the tariffs will be by the countries we're putting tariffs on, right?
You mean there's
Like-
uncertainty inherent in large, complex things?
Yes. And it's not just the tariff thing, but even like the DeepSeek thing.
Yeah.
You know, like you could have reacted to that and, you know, snap sold your NVIDIA because you think, all right, it's over now. Right. But then maybe to our point in our conversation with Nick and Casey from last week, you know, maybe that's short-sighted because yes, it's cheaper and less energy intensive to have AI now, but maybe that means that so many more people will have AI that now NVIDIA's chip sales are higher than even that we thought before all this, right? Like, I don't know that I would have thought of that initially until someone told me, but how many people own NVIDIA just because of YOLO, right?
Yeah,
So, you know, there's second order impacts to these things that I don't think even the experts always know the answer to. So it's just so hard to be right. you know?
Yeah. Well, it's back to the old saying, you know, pundits don't predict because they know, they predict because they were asked, right?
Yeah.
And we want to have some vision of the world. And the problem though, Jeff, is that we start from where we are now. That's built on our life's experience and heavily weighted by what's happening today. And we extrapolate, right? And extrapolation ignores all of the things in between now and the future. That is all of that uncertainty. That is billions of people in hundreds of countries, everybody with different incentives and goals, and all of the unknowns and uncertainties that are going to happen along the way, the most of which are going to be positive and good, right?
Yeah. I think that's true. So let me invert what we're talking about for a second here. Let's talk about what do you think are let's think of this in two buckets, right? There's broad portfolio level things you can do whenever you're thinking like you need to make a reaction to what's happening in the world. And then there's individual stocks and assets decisions, right? So like an example would be, how much cash should I have in my investing account in this type of environment versus that? That would be like the big picture thinking. And then there's, should I sell or buy Apple? Should I sell or buy NVIDIA, right?
Yeah.
Two different levels of thinking. Do you think there are actual changes or tweaks investors can or should make to either one of those levels of thinking when there is big news in the market? Like we keep saying like, no, hang in there, you know, hold through it, wait it out. But
Right.
it
It's
feels
like we're
there's
giving
gotta be
everybody the
some-
motivational poster of the kitten hanging on the tree limb, right?
That's right.
Hang in there.
Hang in there.
Yeah.
Because here's why I'm asking the question. Because I feel like for my own investing, maybe not even consciously, I've done this. And I think I've said this before, which is for the past year or so, I've still been buying stocks pretty regularly, but not nearly as frequently and with as much urgency and excitement as I have in other times. And I don't know how much of that is just me evolving as an investor and how much of it is the fact that when I look through my portfolio of stocks I own, not many of them jump out to me as great deal, super cheap, you know?
Yeah.
So I just find that I'm not making a decision. Like I'm not buying stocks anymore. I'm just sort of not in a rush. And by default, I've built up a cash position that I never thought I'd have, because the money keeps hitting my account because I have an automatic transfer from my checking account, but I've not been buying as much. So that's one way that I'm thinking about it. Like I'm sort of subconsciously, and maybe now consciously because I'm talking about it, reacting to at least the market valuations. But it feels like that's not necessarily the worst thing in the world for some times in the market. But I want you to tell me why you think I'm wrong.
So I think I'm going to invert your inversion a little bit here. But I think as a general starting point, having these two buckets of company level stuff, universe level stuff really makes a lot of sense, because I do think when it comes to like the individual company level decisions, acting based on the things that we learn about companies when deciding whether to allocate more or less money or buy or sell or do nothing, which do nothing obviously that's usually the one that we know is the right thing to do. I think doing that based on company level things has to be your driving force. If you're acting based on markets, economy, geopolitics, all of like that whole bucket of other stuff, to make individual company level decisions, it's almost always going to be neutral to negative, right? It's guys, you're just some person listening to two dudes with a podcast. There's no edge to be found here in terms of market velocity based on macro events that's going to give you extra alpha. It's just not going to be there, right? If you're listening to this podcast, that's not going to be your sweet spot, right? So company level decisions, company level, industry level, opportunity level decisions, and then the big bucket of everything else. And to me, that big bucket of everything else, Jeff, is around the whole gamut of thinking about your long-term goals, your short-term goals, asset allocation based on that stuff is just a starting point. You know, let's say stocks, bonds, and cash, those three things, right? Somebody that's ready for a financial goal, whatever it is, they need to turn something they own into cash now. The way that they need to be allocating their portfolio, again, assuming relative sizes, if somebody has $100 million portfolio, they're anti-fragile. They can be 100% stocks. And even if they just have a minimum amount of diversification, they'll never need to own a bond in their life.
So
right?
You think I'm okay with my portfolio?
Yeah, definitely. For the opposite reason of that. But you see my point, like just again, on the bell curve, right? You fall within the bell curve of like a median sized portfolio. If you're in retirement or at a goal, the way that your asset allocation should be built should be different than somebody that's still 5 or 10 years away versus somebody that's 20 or 30 years away, right? I mean, that's just the reality. Again, that's the capacity to be able to get through stuff happening.
Yeah.
And big stuff happening, right? But then you have to start managing yourself too. And this is a big part of it. This is where I think like the right amount of cash is different for different people, but also individual people as their different versions of who they are as an investor. Jeff, that's a perfect, your situation is a perfect example, right? You're relatively younger as a stock picker, right? You've been putting money away for your entire adult life, but you've been picking stocks for about 5 years at this point, and you've started to learn to recognize when you see opportunities to put your cash into stocks versus when to just continue to hold cash. It's probably helped. This is my question for you. How much of this has been affected by the fact that cash is worth more than just losing ground to inflation now? You can actually get some yield that does make it at least a little bit less unattractive to hold cash. Has that affected you?
I don't think so, because it's not enough for that to be like super impactful. You know what I mean? Is it nice to have a couple $100 a month? Yes. But that's not, if I had $200,000 in cash, like different story.
Yeah.
But so I'm glad you said it's an individual thing, because I think it also depends on, one thing I'm realizing as you're talking and I'm thinking about my own situation is even as I say that I've slowed my pace of buying individual stocks, I have not changed anything about my retirement accounts, right? Like that are tied to my to my paycheck every 2 weeks.
Yeah, the money that's going into those index funds is exactly the same.
Yeah. And that's why I think
So you bought the NVIDIA dip this week, bro.
I did.
Nice job, Diamond Hands.
Yep. But I think that's, I'm not a financial advisor, but to me, it feels like a smart thing for most people, even the ones who are interested in buying stocks, is to have a X% of their portfolio, and that X should be whatever is right for that person, in some sort of automatic contribution to some sort of index fund or ETF, like a base, no matter what happens.
Yeah.
Every
Yeah.
2 weeks, I'm buying X dollars of whatever, this index fund, this ETF, this mutual fund. And then, that allows you to be a little bit more, I don't want to say timing, not time the market, but be a little bit more judicious about like how much to spend in this month versus how much to put away for cash. Like if I were you, if I were
While
100
also like protecting against your own worst instincts.
yeah. If I were someone in your position who like until recently when you started to buy a bunch of bonds was like 100% in stocks, like no index funds, no ETFs, I probably would have cash. Like I probably would build up a cash cushion for
Yeah.
two reasons. One, a lot more money would be hitting the accounts that I see, right? Because I think about the dollar amount that I never see that just goes to my 403b. So it's a lot easier to like build up a cash position and still buy stuff when more money's hitting your account. But two, like I wouldn't have that automatic cushion of the biweekly contributions to my retirement account. So it really is individualized. But I just brought it up because I don't want people to think that what we're saying is you should absolutely close your brokerage account, lose the
No,
password, and
no.
never do anything when there's any uncertainty, because that's not what we're saying.
No, not at all. It gets back to, and this is something I wrote about on Random Words this weekend. Again, building that process that both creates friction between you and your worst inclinations, but also like greases the skids and accelerates the things that you do well. I think that's really the key. And the risk of asset allocation is improper asset allocation that either turns volatility into risk when you don't have the capacity to hold through it because you need the money now, not the stocks, or you don't have the mental framework to hold, right? You know you're going to sell in a downturn, so you can't have too much exposure. But the flip side of that, again, is too much cash over an investing career is a drag on your returns, right? So cash is a risky long-term asset because it loses spending power, and it's rare you go through periods like we're in now where you're actually getting a little bit of yield that's in excess of inflation. Usually, even with decent yields, you're going to trail inflation, right? Much less what we saw in the entire 2010s and 2010s. So it's the same way with bonds, right? Understanding where they fit in the risk profile and, not having so much that they impact your long-term returns, but not having too little when you get into that transitionary period. But also if it's just a tool that it just helps you manage yourself. Because Jeff, I will tell you, the bond exposure that I have now and the cash exposure that I have now, I want to say it's crept up to the point that it's like 30% of my 401k. Now, I have a Roth. My wife and I have a joint account, taxable account. My wife has some rollover retirement accounts. So if you aggregate it across all of those, it's not 30% cash and bonds. And it's like 20%, over 20% cash in my 401k. It's high. I've also learned to do other things that help me in situations like this where I feel like the vibe for me right now is the same as yours. I feel like a lot of the things I'm interested in are just too expensive. But I'm in my 40s and I'm a net contributor and I'm saving for, like you said, God willing, 30, 40, 50 years from now even. I can't just hold cash and bonds and not ever buy more stocks. So doing things like still having those rules where my goal is still to have around 10% cash. And I've changed it to 10% unrestricted cash where I can take that cash and I can go buy something. A lot of the cash that I have now is covering puts. So we've had Jeff Fisher on talking about options. One of the things that I've begun to do is companies that I really like and I really want to own more of, but I don't want to pay this price. I'm selling puts, long dated puts, like a year or 2 years out. The upside is I get paid that put income. The downside is that I have to the cash to buy all of those shares at that price. It's all tied up, right? I can't go below that amount of cash in my brokerage. So if I'm going to have the rule that I put in place is, and it's not a firm rule, and we'll see if it gets tested when I'm about to start making contributions for the new tax year, where that cash needs to be productive for me. And part of the way it can be productive is beyond that, 4% yield, which is not enough. It's good, but it's like you said, it's not enough, is that put income and the risk of buying a stock in the future that might drop below the price that I've agreed to be willing to pay. So I'm still putting it at risk, but it's a level of risk that I'm comfortable with, right? Mm-hmm. So it's helping me manage myself while still having productive assets that are going to help me reach my long-term and financial goals, and managing through the stuff happens. There's always something environment that we always find ourselves in.
Yeah, no, that makes sense. And it's actually, I think, a good segue to the last thing I think we should talk about, which is what to do like now to sort of future-proof your portfolio, your process, your mindset against the next time stuff happens, right? Because, you know, the reason for starting the beginning of the podcast by going down a trip down terrible memory lane was to just illustrate how often these things do happen over the course of just a couple of years.
Yeah,
And
all the time.
even if they're not at the level of like COVID, right? That was like the biggest example, but all these littler ones happened all within the last couple of years. And I'm thinking through like, is there anything I'm doing purposefully to prepare myself, so to speak? And I think I'm doing a couple things, and then I want to hear what you do. So I'm accidentally building a little bit of a cash cushion by just being a little more patient. Now, that might not be the case when the actual next downturn happens. I might spend it because I might just over the next couple of weeks or months decide, okay, I'm going to buy a couple things here and there. But I think the bigger thing that I'm doing is I'm trying to really, really understand everything I own, what my conviction level is in it, so that when the falls happen, I can make a decision based on knowledge of the company and what I think it can do, and not just the stock price movement.
Yeah.
So like, here's an example. I've talked recently about being pretty bullish on PayPal, and I've bought some recently in the last month or two or three. Not a lot, just added to my position a little bit. They reported this week, and I thought largely the report was fine, but the stock was down. I don't know. Yesterday they reported it was down 8 to 10% today. And because I know what I'm watching for, I didn't do anything today. I didn't buy any more. I didn't panic or freak out about the little bit that I did buy. That's now it's 10% lower. What I did was I updated all my spreadsheets and I looked at the results and I said to myself, okay, like small step back from what I was hoping, but not anything concerning. And maybe I will buy more, but
Yeah.
maybe it'll be next week or in a month, right? But I want to know, I want to have that level of understanding heading into the event of the fall, because here's the converse. Outset Medical, drink Tyler, Outset Medical drops 10% like once a week.
Yes.
So,
Yeah.
so if I bought every single time it dropped just because it dropped, I would be in a much worse financial situation with that stock, which
Right.
has just crushed me. And that's the big difference, right? Like I know in both cases what I'm looking for and what I think can happen or hope will happen. And that helps me not make a decision based on the stock's price movement, but on the business results. So I think it's a mental thing for me. That's the way I'm preparing. Cause like I keep thinking about when is the next 2022? When is the next 18-month long slog where my net worth drops by 12%, 15%, you know?
Right.
And how am I going to be ready for that? Because it will happen.
Yeah, no, I think that's exactly right, because the COVIDs and the financial crisis and the .com bust, like those events are massive. And those are situations where, of course, it's going to be tempting and the pull to get out is going to be real, and it's going to be material and based on things that are affecting every company. What we have to acknowledge sometimes is that there are always going to be things that are happening that feel big, but aren't. And sometimes there's going to be things that we just don't know what the real impact is going to be, like the potential threat of tariffs and a protracted trade war, which all of that is still on the table for 2025, upsetting markets, upsetting economies, and leading to a protracted period of below average returns. We don't know, right? Those things, they're unknowable. They're absolutely unknowable. So thinking about selling stocks to build cash based on those sorts of things, if you get it right, you're lucky, right? And acknowledging that is good. But if you're doing it because you should have already done it, but you're doing it now, because if we do go through a period of downturn, having that cash is going to be part of your toolkit that's going to prevent you from selling something that's down that you should be buying, right?
Yeah.
I think it's fine to do if you're reacting at this point to build, like kind of what you're talking about here, to build a process and a framework and putting the rules in place to help you make the right decisions based on the environment. And making those individual company buy and sell decisions should almost always entirely be made on company level things. PayPal is an example. The stock was down 8 or 9%. I don't know exactly how much it closed down, but it was down a lot on results that on the surface looked pretty good and that mostly were good and were a continuation of the direction Alex Chris put the company on. Like a little bit of growth with active users, and some of those volumes were good. But then you start looking at like their unbranded payments processing business with Braintree. It's a subsidiary that does like Uber and
Like white label payments. Yeah.
yeah, white label. That business is a little weak right now. And the concern is there's been a lot of focus on like the branded parts of the business, PayPal and Venmo and that sort of thing. Is Braintree about to start turning over customers? And is that the next thing that's going to upend the turnaround for PayPal, right? So there's still things that aren't perfect, right? But that's when we have to start making the judgment call decisions. Am I right or wrong about this? Should I buy or not? Is the price down? Is it maybe the market's got it right, but it just means there's enough margin of safety now that the margin's betting that it won't work out. And if it doesn't work out, it's not going to hurt the stock. The good stuff that is happening that Chris is leading still makes this price make sense, right? You're making those decisions based on the business, not mumbo jumbo about trade wars and economic policy and geopolitics and things that 10 years from now, you're probably not even going to be thinking about in relation to any of these businesses, right? So frameworks get you through all the stuff that drives you crazy now. Individual company stuff is where you find opportunities to buy more of the companies that are going to help you create wealth. All the other selling is based around position sizing, risk, and getting closer to financial goals. And it's time to turn a company into money. Even if I think it's a great company, I need money, not a company. So I'm going to sell some of this company.
Yeah.
We could say a lot more about this, Jeff, but I don't know that it would benefit anybody except for our ability to put more ads in the podcast.
Don't worry, I'll put the ads in regardless. So
Love it.
Don't let that slow you down.
Okay. Fantastic. All right, friends. I think we have definitely said enough, but the key, and I just want to kind of sum all this up, Jeff, before we do wrap it up here, is there's always going to be stuff, and that stuff's going to create uncertainty, and whatever your bias might be, it's going to feed that. Market's running. I got to keep buying. The momentum's going to be good. I need to buy more. Or if you're old farts like me and Jeff, where you're like, oh, it just seems kind of expensive. I own enough stuff. I'm just going to keep owning that. And maybe I'll buy something when I see the opportunity. Your biases are going to push you in that way. So it just gets back to so much about building the frameworks that support the best version of yourself as an investor based on what you're actually trying to accomplish with your goals. Something you can do it.
What a wonderful ending.
Okay. All right. We're going to do the actual ending now. Jeff and I love to give our answers to these hard questions about investing. The complicated stuff to me, the messy stuff, is the funnest stuff to talk about. But our answers are not your answers. You can find your answers out there, people. I believe in you. You can do it. All right, Jeff. I'll see you next time.
See you next time.